So why are annuities paying much higher rates for lifetime income nowadays, and why should we even care? Why should a retirement income seeking investors even look at annuities? As per this chart, you can see that annuity payouts for guaranteed income for life are tied directly to the level of interest rates. The higher the rates are on bonds which annuities invest in when an investor gives them money, the higher the payout those annuities can produce. So rates have gone up. Of course, they are forecast to come back down. So consequently, when rates come down, new annuity investors would have to be locked into those lower rates if they miss these higher rates. The second point, why or how do annuities afford to pay a much higher rate than an investor can afford to provide for themselves from their portfolio? Annuities use the laws of statistics and life expectancy to their advantage. See, when we plan, or when an investor plans for their retirement and providing income from their portfolio, they have to plan well into their 90s, because a significant percentage of people alive today will live well into their 90s. An insurance company, however, that provides an annuity income stream for an investor who is in their early 60s, for instance, when they're purchasing a retirement income annuity, only has to plan for the average investor. And on average, an investor lives into their early 80s. And the insurance company, given that they have tens of thousands of investors, are subject to this average rate, and therefore only have to plan for the average investor to live till 82. Therefore, they can afford to pay a much higher rate, often into the 8% or higher on the money invested, versus an individual investor or a couple which has to plan for their own portfolio to last well into their 90s.